The year is 2025, the economy is a bit wobbly, inflation is still a concern although it has cooled down some. The Federal Reserve, our nation's central bank, has a big decision to make. Will they cut interest rates? It's a question on everyone's mind, especially if you're thinking about buying a house, investing your savings, or even just trying to make ends meet. Right now the Fed is playing it cool. They've kept interest rates steady for a while. Think of it like watching a pot of water on the stove. They're waiting to see if it boils over or simmers down. Their decisions have a ripple effect on everything from mortgages to car loans. But here's the interesting part. Even though the Fed is holding steady for now, they've hinted that rate cuts could be on the horizon. Like maybe even later this year. They're watching the economic data like hawks. They want to make sure they're making the right move. Why does this matter to you? Because the Fed's decisions impact your money. Lower interest rates could mean cheaper loans. But they could also mean lower returns on your savings. It's a delicate dance and we're all watching closely. Let's talk Fed speak. They've got this whole language of their own, and it can be confusing. But here's the gist. Some important folks at the Fed have been dropping hints. They're saying that rate cuts could happen as early as June if the economy takes a turn for the worse. Now these aren't guarantees. They're more like educated guesses based on what the economy is doing. One big shot at the Fed, this guy named Hammock, even said that they could cut rates in June if the economic data is convincing enough. It's like they're waiting for the economy to give them a sign. But remember, the Fed doesn't operate in a vacuum. There are all these other factors at play, like what's happening with trade and tariffs. Those can really throw a wrench in things. Here's the bottom line. The Fed is trying to find that sweet spot between keeping inflation in check and making sure the economy keeps growing. And their decisions? They're going to have a direct impact on your wallet. Trying to predict the economy is like trying to predict the weather. It's an inexact science, to say the least. But we can look for clues, right? That's where economic indicators come in. Think of them as the economy's vital signs. Right now, some of those vital signs are looking a little sluggish. Experts are predicting slower economic growth this year and unemployment might tick up a bit. And then there's inflation. It's cooled down, but it's still not where the Fed wants it to be. But here's a glimmer of hope. Core consumer prices, which exclude food and energy prices, have been behaving themselves lately. They've actually gotten closer to the Fed's target. That's a good sign, and it could make the Fed more likely to cut rates. So what does it all mean? It's a mixed bag, folks. The economy is sending out some confusing signals, but one thing's for sure. The Fed is watching closely, and so should you. Section 4, Riding the Rate Wave, How Potential Cuts Impact Your Money. Okay, enough with the economic jargon. Let's talk about how this whole rate cut thing could actually affect your hard-earned money. Because that's what really matters, right? First up, borrowing. If the Fed cuts rates, it usually means lower interest rates on things like loans, mortgages, and credit cards. That's good news if you're thinking about buying a house, refinancing your mortgage, or even just carrying a balance on your credit card. But here's the flip side. Lower interest rates can also mean lower returns on your savings accounts and other investments. So, if you're relying on your savings to grow, you might not be as happy about a rate cut. And then there's the stock market. Rate cuts can sometimes give the stock market a boost, at least in the short term. But remember, the market is a fickle beast. It can change directions faster than you can say interest rates. The bottom line is this: rate cuts can be a double-edged sword. They can be good for borrowers but not so good for savers. It all depends on your individual circumstances. Section 5, Navigating Financial Waters, Strategies for an Uncertain Economy. So, we've established that the economy is a bit unpredictable right now. The Fed might cut rates, they might not. What's a person to do? First things first, don't panic. Remember, you're in control of your own financial destiny, and there are things you can do to weather any economic storm. One of the smartest things you can do is diversify your investments. Don't put all your eggs in one basket. Spread your money around in different types of investments, like stocks, bonds, and real estate. That way, if one area of the market takes a hit, you're not completely sunk. And speaking of not being sunk, now is a great time to build up your emergency fund. Aim to have at least 6 months worth of living expenses saved up in a safe, accessible account. That way, if you lose your job or face an unexpected expense, you'll be financially prepared. Finally, stay informed. Keep up with the latest economic news and Fed announcements. The more you know, the better equipped you'll be to make smart financial decisions. And remember, you don't have to do this alone. Talk to a financial advisor if you need help developing a financial plan that's right for you. The economy might be uncertain, but your financial future doesn't have to be. By taking steps to prepare and staying informed, you can navigate these choppy waters with confidence.